Right now, sitting in the federal tax code, written into law specifically for people your age, there are 5 deductions worth potentially tens of thousands of dollars that most retirees never claim. Not because they're complicated, not because you need to be wealthy to qualify, simply because almost nobody explains they exist. And the tax software millions of Americans use every spring is often built around outdated assumptions that don't reflect the newest provisions Congress passed. If you've been taking the same standard deduction year after year without checking what's actually changed, there's a very real chance you have been quietly overpaying the federal government. My name is Finn, and this is Finn Retires, the channel that exists to make sure the money you worked your entire life to save doesn't leave your pocket a single dollar sooner than it legally has to. If this is your first time here, please hit that subscribe button right now before we go any further. Every week on this channel, we cover the rules and overlooked opportunities that directly affect retired Americans' financial security. And today's topic is one of the most immediately actionable things we've ever covered, because every deduction here is something you can check on your very next tax return. So subscribe, and let's make sure you're keeping every dollar you're legally entitled to. Let's start with a deduction most retirees have some awareness of. This is the extra standard deduction available specifically to anyone 65 or older. On top of the regular standard deduction, the IRS adds an additional amount for taxpayers 65 or older by the end of the tax year. For 2026, that additional amount ranges from $1,550 to $1,950, depending on filing status. If both spouses are 65 or older, this additional deduction doubles. Both spouses individually qualify for their own extra amount, stacked on top of each other. This isn't new, and many retirees claim it correctly. But a surprising number don't, particularly retirees who turned 65 partway through the year, or whose tax preparer is working from an older reference sheet, not updated with the current year's exact figures. The second deduction is genuinely new, and most retirees watching this have never heard of it. This is called the Senior Bonus Deduction, created under a 2025 tax law officially known as the One Big Beautiful Bill Act. It provides up to $6,000 per qualifying filer, or $12,000 for a married couple where both spouses are 65 or older. And critically, this bonus applies whether you take the standard deduction or itemize. Most deductions force you to choose one path. This one doesn't. There's a phase out to be aware of. The deduction begins reducing once income crosses $75,000 for single filers or $150,000 for married couples filing jointly. But for a large percentage of retirees below those levels, this is essentially $6,000 or $12,000 in additional tax-free income that didn't exist before this law passed. The IRS only published its official guidance confirming exactly how this deduction works in February of 2026, which means it's genuinely possible even your own tax preparer could miss it if they haven't specifically updated their process for this tax year. The third deduction requires more effort but can represent real money. This is the medical expense deduction, available to retirees who itemize. The rule allows you to deduct qualifying medical expenses that exceed 7.5% of your adjusted gross income. Healthcare costs rise significantly later in life, meaning a meaningful share of retirees actually clear that 7.5% threshold, sometimes by a wide margin, particularly in years involving a major medical event or ongoing long-term care costs. Many retirees never actually run the calculation. They assume the standard deduction will always be better and never add up their actual medical expenses to check. For a retiree with a significant medical expense year, skipping this calculation can mean leaving a substantial deduction unclaimed. The fourth deduction is brand new for the 2026 tax year, and it directly targets a group usually excluded from charitable deductions entirely. Historically, if you took the standard deduction, your charitable cash contributions provided no tax benefit unless you itemized. Starting with the 2026 tax year, that changed specifically for cash charitable contributions. Even standard deduction filers can now deduct cash contributions up to $1,000 for single filers, or $2,000 for married couples filing jointly, from the same 2025 law that created the senior bonus deduction. The fifth strategy isn't technically a deduction, but produces the same effect, and for retirees subject to RMDs, it can be the most powerful of all 5. This is the Qualified Charitable Distribution, money you'd have withdrawn from your IRA anyway, up to $108,000 per year, directed directly to a qualified charity. That amount never counts as taxable income in the first place. This matters because RMDs, which begin at age 73, increase your taxable income whether you need the money or not, and that increased income can push more of your Social Security into taxable territory and even affect Medicare premium surcharges. Now, let me show you what happens when you stack these together. Individually, each sounds meaningful but modest. Combined, the effect is genuinely large. Consider a married couple Raymond and Sylvia, both 71, filing jointly with combined income comfortably below the phase-out thresholds. Between them, they qualify for the regular standard deduction, plus the extra standard deduction doubled, plus the senior bonus deduction doubled at $12,000 combined. Tens of thousands of dollars in combined deductions before any additional strategy is even applied. Raymond and Sylvia had used the same tax preparer for over 15 years, but their preparer, managing a large volume of clients, was working from a process built up over years with the tax code, as it existed before 2025. When Raymond mentioned he'd heard something on the news about a new deduction for people their age, his preparer initially wasn't certain it applied, and had to independently verify before confirming Raymond and Sylvia qualified for the full $12,000 senior bonus deduction. That single conversation, prompted by a passing comment rather than a system that automatically flagged the opportunity, resulted in a genuinely significant reduction in what they owed. Even good, experienced tax professionals can miss provisions this new. The responsibility for knowing these provisions ultimately rests with you, not because the system is unfair, but because tax law changes faster than any single person, however qualified, can always track perfectly. Here's what I want you to do before you file your next return. First, confirm the exact extra standard deduction amount you and your spouse qualify for based on your current age and filing status, rather than assuming last year's number is still correct. Second, specifically ask your tax preparer, by name, whether you qualify for the senior bonus deduction, and confirm whether your income falls under the phase-out thresholds. Third, if you had significant medical expenses this year, actually calculate whether they exceed 7.5% of your AGI. Fourth, if you make charitable cash contributions and have always taken the standard deduction, ask specifically about the new below-the-line charitable deduction. Fifth, if you're 70.5 or older and charitably inclined, talk to your preparer about directing your RMD through a qualified charitable distribution. None of this information is hidden from the public. Every deduction we've covered is published directly by the IRS, confirmed through official guidance issued in February of 2026. But publicly available and widely known are two very different things. The gap between what exists in the tax code and what actually gets claimed on real tax returns is exactly the space this channel exists to close, one video at a time. If this video gave you information that could genuinely reduce what you owe this year, share it with someone 65 or older, particularly if they've used the same tax preparer or approach for many years without recently revisiting it. A share from you today could put real money back into someone else's pocket this tax season. Drop a comment below. Did you already know about the senior bonus deduction before watching this video? Have you calculated whether your medical expenses exceed the 7.5% threshold this year? I read every single comment personally. The next video on this channel is going to build directly on today's topic, walking through exactly how these deductions interact with Social Security taxation and Medicare premium thresholds. If you're not subscribed yet, hit that button right now. Take care of yourself, protect what you built, and I will see you in the next one.